Good afternoon. It's a pleasure to be here at the meeting of the BGSE for several reasons. Now, the first is I have many good friends around. The second is that I've been in academia for many years, so it's good to be back with academics, although I may be playing the worst part in this panel. I mean, I'm the only banker, as you can see. It's the only tie in the panel. So at least there is someone with a tie in the audience. Okay. Then the other thing, it's a pleasure to be here because you may know, you may be familiar that Caixa has sponsored BGSE from its birth. And I've had the honor to see how the institution has flourished. And I'm a member still currently of the Board of Trustees of the institution. So I welcome the opportunity to join you today. Now, this is a challenging topic to say something useful in 11 minutes because I consume one. So what I'll do is I'll tackle 4 issues that bother me about regulation. And I'll tackle them in sequence. And if I run out of time, I'll stop with the 3rd item. So the first thing that worries me about the regulatory initiatives that have been taken after the financial crisis are the ones that have to do with capital requirements, with bail-in requirements, with all the cushions that regulators want to build to make sure that there is a cushion in case a new crisis happens, and to make sure that bankers, owners of banks and managers have more skin in the game so that they refrain from taking more risk. Now, the concerns that I have with this is that the regulatory approach that has been taken is exactly or very similar to the one that we had before the crisis, before Basel II. And that one demonstrably didn't work. And it didn't work in part because the way the regulator sees risk it's not the appropriate way. I mean, the regulator doesn't really see the risk that is really building within banks. The risk measures that regulators use are poor measures. This has been demonstrated in the last crisis, and the changes that have been introduced are very minor and do not change the real picture. Didn't bring any slides today, but I have several that show that. Therefore, it is unclear to me that despite the higher capital requirements, there will be less risk in the banks. In particular, because the banks, since risk will go unnoticed, will have the same incentives. Since they have limited liability, they will have an incentive to bet, and they will do it. And there are several models that you can build that show that this will happen if the regulator doesn't assess properly risk, which is the case. The second thing that worries me about the regulations of capital, the regulatory ratios of capital and the bail-in instruments that are being developed and the leverage ratio is the cost to society that these regulations may impose. I know my academic friends based the idea that this will have no cost, at least in the long run, on Modigliani Miller. And some of you that know me already know that I disagree with that view, that Modigliani Miller is fine, except for the fact that in banking, debt is huge, and the cost of debt are deductible from profits. In banking, you cannot, as a private investor, mirror what the bank does, because as a private investor, you cannot access the central bank. And moreover, I believe that in a world of asymmetric information, such as the one that prevails in banking, it doesn't make any sense to use Modigliani Miller. I prefer other models of pricing the different claims of a bank. And therefore, I'm convinced that even in the long run, the introduction of these regulations is going to be costly. Now, not only that, in the short run, they are already being costly, because in the short run, when you request more equity or more bail-inable assets to be brought into the bank, that is confronted with a limited supply. And it implies that the price goes up, the costs go up, and in some cases you cannot even raise that equity or that bail-inable debt. When that is the case, what do the banks do? They deleverage. They reduce the amount of assets and they contract loans and credit. And you may be engineering a credit crunch by so doing. So much for my cursory remarks on capital regulation and bail-in, which have their advantages, but I think that they have significant shortcomings. My second remark is going to be about liquidity requirements. I was astonished when the liquidity requirements were introduced by Basel III and the way they have evolved. I was astonished because one of the critical social functions of a bank is, and economic functions, is maturity transformation. And what the liquidity ratios want to do is to basically constrain that ability to transform maturities. That is fine with me if we are able to obtain institutions which make the job. Many people in our society want to have cash in the short term, and there are other people requesting funds to be invested for the long run. Banks undertake that maturity transformation, but the regulations that have been introduced constrain significantly that job. I think that when one wants to correct for the liquidity crisis that we have observed, one has to have a clear idea of what is behind those liquidity crises. If the crisis had at its origin a problem with an individual bank that was relying excessively on short-term funds, then you can think of ways of, through surveillance or even taxing maybe short-term wholesale funds, to penalize that behavior. Those are possible ideas instead of the very detailed liquidity ratios that are being introduced. And if the problem is systemic, which oftentimes it is, then you have other tools. If the problem is of a systemic liquidity crisis, you have the lender of last resort, that's why it was created. And then you should tackle the problems of confidence between banks that generate the liquidity freeze. And usually they are problems of solvency, not of liquidity. The problem with the instruments that are being introduced is that they narrowly define the different elements in the bank, what's liquid, what's not liquid, what's a stable deposit, what's not a stable deposit. In defining what's liquid and not, you affect the behavior of those particular markets where the assets are determined by the regulator to be liquid, affecting the supply, the demand, and the price. And when you introduce in the regulation what's a stable source of funding or what are committed or not committed funds by the bank, you affect the business models of the banks, sometimes with unintended consequences. My experience tells me that any regulation that has to become so detailed is bound to be a failure. And I think that the liquidity ratio is an example of that. And last but not least, given the complexities of the industry, if you do not calibrate the liquidity ratio well, you can create a huge shortage of liquidity in the banks. What will be the reaction of the banks if they have a shortage of liquidity? Again, deleveraging, okay? Selling assets, shading assets. Yesterday, I had the chance to meet a very famous economist and very senior policymaker, which is Jacques de la Rosière, in a meeting. And by his account, the current calibration of the LCR will imply a shortage of 1 trillion euro by the time this gets binding, which is in January 2015. So it better be the case that, if this is correct, it better be the case that the ECB introduces a new LTRO. Otherwise, we might be in trouble. Let me move quickly to at least the third of the items that worries me. The third has to do with the structural separation legislation that is being introduced. It has been introduced in the US through the Volcker rule, in the UK through the Vickers proposals, and then in Germany, in France, and then in Europe we have the Liikanen proposals, which are still under examination by the Commission, and there will be a proposal this summer. The first thing that the goal of these proposals, of course, is to prevent that banks which are enjoying an explicit or implicit subsidy by the public sector engage in risky activities with the idea that heads I win, tails you lose, right? And so the idea is to prevent moral hazard. Now, on the one hand, some of the other regulations I discussed already tackle these issues. So this is on top of the other regulations. But, okay, let's leave that aside. The problem that I see with the structural separation is that you have to balance, first problem is you have to balance carefully the advantages, the scope economies generated in banks by undertaking simultaneously several types of activities with the problems that undertaking these activities generate in terms of conflicts of interest, which go unnoticed by the supervisor, right? The supervisor cannot detect the activities of the bank unless they are separated to a certain degree. They can be legally separated on an accounting basis or even in ownership separation, right? So it's a very complex problem. But even if you decide that you know what effect dominates, whether it's the conflict of interest or the scope economies, and even if you know whether you should separate ownership, an accounting basis or a legal basis, you still have the problem of exactly where to draw the line. And my experience tells me that this is the most difficult problem. Ideally, in an ideal world, you would like to separate what you call proprietary trading, right? Something which is done for the client, you want to leave it there, but something which is done on the own account of the bank, you want to play it aside. Well, how about market-making activities? Where do you put that? And worst, in practice, we can talk about proprietary trading, we can talk about market making, we can talk about trading on the account of the client, but in practice you have accounting categories, which are the trading book, the available for sale, and the book to maturity. And the ones that you would like to remove do not correspond to the ones that go in the books of the banks. So you have a practical problem which can lead to decisions by the regulator which may not be precisely the best ones. And in fact, as in the other cases that I have mentioned, can lead to unintended consequences. Now, the fourth item that I had in my list, which I'm afraid I will have no time to develop because I try to stick by the 12 minutes that I was allocated. The fourth subject, I just want to mention it, is the procyclical character of banking. Banking, by its own nature, tends to amplify the economic cycle, and one of the goals of the new regulation should be to moderate that amplification character of the industry. To me, the best instrument for that, and I will leave you with that, would be to limit the loan-to-value and loan-to-income ratios, particularly in the mortgage market. This, for reasons that we may discuss in the panel, has not been done. Thank you.